Hi there. If your tax code has changed unexpectedly, this guide explains what it means and how to fix issues with HMRC.
Most people ignore the short string of letters and numbers printed on their payslip, but when you retire, failing to monitor that specific code can immediately drain hundreds of pounds from your monthly income. Welcome to The Explainer, brought to you by My Tax Accountant. Today, we are going to decode exactly why pensioner tax codes change, how automated errors drain retirement accounts, and the exact steps required to get your money back. To see how this happens, we'll follow Arthur. He's a recent retiree who set up a very standard financial plan for his post-work life, drawing from two reliable income streams. This bar chart lays out Arthur's expected baseline. He receives the new state pension, paying £11,500 a year. He pairs that with a private company pension, paying £9,000. Together, that's £20,500 of annual income. But when Arthur's first private pension payment arrives, it is drastically lower than he projected. The culprit is printed right on the advice slip. His standard tax code, 1257L, has inexplicably changed to 107L. A tax code is an active, binding financial instruction. It dictates the precise amount of cash HM Revenue and Customs permits a provider to pay you each month, and Arthur's new code is telling his provider to withhold a large chunk of his money. This capacity gauge represents the UK personal allowance. Every taxpayer gets this baseline. For the current tax year, the first £12,570 you receive is completely tax-free. Here is the catch with retirement. The Department for Work and Pensions pays the state pension gross. They do not deduct tax before sending you the money. However, the state pension is still classified as taxable income. Because the government doesn't tax the state pension at the source, HMRC has to find another way to collect what you owe. They turn your private pension into a tax collection vehicle. HMRC subtracts Arthur's £11,500 state pension directly from his £12,570 personal allowance. That leaves a tiny tax-free sliver, exactly £1,070. To create a tax code, HMRC simply drops the final zero, resulting in 107L. Because Arthur's tax-free shield on his private pension has been reduced to almost nothing, the vast majority of that £9,000 payout is now exposed to the 20% basic tax rate. That generates a tax bill of £1,586. Drawing multiple pensions breaks the simplicity of the standard tax code system. It shifts the burden of tax collection entirely onto your private provider, shrinking your monthly payout in the process. Later that year, Arthur faces a new complication. He needs a roof repair, so he accesses a separate, flexible pension pot to withdraw a £10,000 lump sum. When Arthur withdraws $10,000, HMRC's system panics. It misinterprets this one-off payment as a monthly salary, projecting an annual income of £120,000. Arthur gets an emergency tax code, taxing the withdrawal at 40% and stripping his capital. You do not have to fall into this trap. If you are planning a flexible lump sum withdrawal, there's a simple preventative strategy you can use. It's called the £1 hack. By withdrawing a nominal amount, like a single pound or £100, you force HMRC's system to generate a correct cumulative tax code for that specific pension pot. Once the provider applies the corrected code, you can safely withdraw your main lump sum. UK tax software is built to process predictable monthly salaries. Modern retirees with flexible drawdowns have to proactively manipulate the timing of their withdrawals to avoid massive automated penalties. If you are hit with an emergency tax code, you do not have to wait until the end of the tax year for a P800 reconciliation letter to get your money back. This dashboard illustrates your first line of defense, the gov.uk personal tax account. Log in to verify your estimated income. Crucially, you need to delete any old, inactive employers still listed on your profile. Left uncorrected, the system applies your allowance twice, creating a debt you will pay back later. To recover an overtaxed lump sum immediately, you need to submit the correct digital paperwork. File Form P55 for a partial pot withdrawal, or Form P53Z if you emptied the entire pot. Submitting these triggers a refund, usually within 30 days. If HMRC sends you a surprise bill for tax underpaid in previous years, check if you qualify for Extra Statutory Concession A19. This is a legal mechanism that allows you to cancel historical tax arrears if you can prove HMRC failed to act on information you already provided them. Escaping the retirement tax trap requires active compliance. If you don't serve the automated system with the correct forms, it quietly holds onto your cash. Arthur filed his forms and received his emergency tax refund via BACS a few weeks later. By updating his tax account online, he corrected his code and restored his optimized monthly income. Letters like K, BR, or L are active financial threats or benefits. Retirees must vigilantly monitor every payslip and challenge codes that don't match their actual income structure. Please note, this video is for educational purposes only and does not constitute personalized financial advice. Tax laws and allowances are subject to change. Don't let the taxman take more than you owe. If you need help deciphering your tax code or recovering overpaid pensions, contact my tax accountant. Call us at 0208 570 8531 or email info@mytaxaccountant.co.uk for tailored professional advice. And be sure to subscribe to the My Tax Accountant channel for more expert guidance on protecting your wealth.